Welcome back. This is episode 220. In this video, I'm going to cover 7 year-end tax tips that retirees should consider making before 2024 is over. So stay tuned to the video to get all tips and also a way on how you can get a free download of my recent book, Fiduciary: How to Find and Hire and Establish a Trusted Relationship with a Fee-Only Financial Advisor. Welcome back. This is episode 220. I can't believe that we're getting close to the end of 2024. It's almost the fourth quarter. And as we get close to the end of the year, it's definitely a good time to think about tax planning. There's a number of things that you can do with regard to your income to potentially lower your income and have some tax savings as a result of that, especially as a retiree. So in this podcast, I'm going to cover 7 tips that you should be thinking about as we get close to the end of 2024 that could potentially help save you a significant amount of taxes. Before I get into that though, a large part of what I do is trying to educate people on retirement planning, and I have a few in-person retirement planning classes. I have a course called Retirement Readiness Review. That's a 2-night course where I cover the gamut on many of the things that I go over in this podcast. So if you're local in Connecticut and you want to attend, if you go to retirewithryan.com and you click on courses, you can check out the live courses. Or if you're someone who is not local to me, but you're still interested in getting this information on how to really best prepare for retirement, then I also have an online course where everything I go over in the live course and also a few additional lessons as well are available. So if you, again, go to retirewithryan.com and click on courses and click on Retirement Readiness On Demand, you can sign up for my on-demand course where you can also take the course at your own pace and also have access to the information over your lifetime. So check that out. So first thing you should be thinking about if you're retired is the tax that you're paying on your Social Security. I talked about it a few episodes ago, but just a quick recap, it's possible for some individuals to pay 0 tax on their Social Security benefit. And what Social Security does is they take, or the IRS, I should say, as far as how they calculate the taxation on your Social Security, you add up, you take half of your Social Security, and you then add that to any other earned income you have for the year as a retiree, whether if you're working part-time or just income in general, so dividends, interest, IRA distributions. And if that number is less than $25,000 as a single individual or $35,000 as a married couple filing jointly, then you pay 0 tax on your Social Security benefit. So it's possible that you could keep an eye on your income for a few years, maybe until you reach RMD age, which is age 73, which is required minimum distribution. At that point, you have to take money out of your retirement accounts. But before that point, you have the option to choose where and when you take your money. So it's possible that there could be some savings on your Social Security, and you could save paying federal and state income tax on that. If you go over that threshold, then for a single individual, if that number is under $34,000, or as a married couple filing jointly under $44,000, then only half of your Social Security benefit is taxable. And once you go over that $34,000 or $44,000, then all of your Social Security benefit is counted in your income for taxation purposes. So it's just something to keep in mind. Maybe you can potentially lower your income this year by not taking out money from your IRA accounts for the remainder of the year, and there could be some tax savings on your Social Security. Another thing to think about is once you start collecting Medicare, once you go on Medicare, you have to keep an eye on your income because everyone pays a standard Medicare rate. So for 2024, that number is $174.70 per month. That's the Part B premium that everyone pays. Now, if your income's over a certain threshold based on your income 2 years prior, because that's what the IRS uses and the government uses to determine how much you pay for Medicare, then you can pay an additional amount above that $174.70 per month per person. So that number as a single individual for this year, 2024, was over $103,000, and as a married couple filing jointly was over $206,000. So instead of paying $174.70, you'd be paying $244.60. So that's just the first level. This is an income-related monthly adjustment on your Medicare Part B premium. And there's also an additional amount if you're on Medicare Part D. I think it's additional $12 in change per month. So why I'm telling you this is because a lot of people don't know about this. And again, you have control of your income. If you're thinking about taking money out of your IRA, taking a distribution for this year, or you're thinking about realizing a capital gain, that all counts as income. So you want to know how that could potentially impact what you're paying for your Social Security, for your Medicare premium down the road, because it's always a 2-year delay. So it's not going to impact you next year, but it's going to impact you 2 years from now when your 2024 tax year is used to determine your 2026 Medicare Part B and Part D premium. So it's not always possible for everyone. Maybe you can't actually lower your income and you're just going to be stuck paying IRMAA. That's probably a good problem to have, because that means you have pretty significant income in retirement. But if you do have the opportunity to maybe lower that by taking money out of different accounts, it's something that definitely you should be looking into. And all these tax tips that I'm going over, they can be complicated. Tax planning is complicated, and that's why the help of a good financial advisor who has knowledge of this information and can help you with tax planning, and or a good CPA in conjunction with your advisor can be very helpful. If your financial advisor is not providing you tax planning like this, if they're not talking to you about your income as a retiree, where you're taking it from, what your projected income looks like for this year, also for next year, then that's maybe a reason to reach out to an advisor who actually helps with tax planning and will work with you in conjunction with your CPA. So this is a large part of my practice that we help clients with, so something to think about. So the third thing is going to kind of be counterintuitive to what I just talked about, and that is a Roth conversion. So if you're fortunate to have a significant retirement account in the $1 million or $1 million plus range, and you're trying to leave a legacy for your children or your grandchildren, having some of that money in a Roth account can be very powerful, because they can inherit that money and it won't be taxable to them. But what I see from working with people is that most people actually have pre-tax retirement accounts, because prior to 1997, that's when the Roth IRA was introduced. Everyone was saving in pre-tax accounts. And it still makes sense for a lot of people to save as you're getting closer to retiring in pre-tax accounts because of the deductions that they offer. But the negative is, at some point, whether in your lifetime or your beneficiary's lifetime, that money will have to come out of those pre-tax accounts and be taxed. So what you can do as the owner of those accounts, if you have significant IRA assets, 401k assets, retirement plan assets that are pre-tax, you can consider paying the tax now instead of your beneficiary paying that. Well, why would you want to do that? Well, if you thought that you're going to pay a lower tax rate than your beneficiaries are going to pay, if your beneficiaries are your children, let's say, and they're successful, they have high income, income higher than you have, or you just think tax rates are going to go up in the future, then it might make sense for you to pay some taxes now on some of this pre-tax money and move it over to a Roth. That's what a Roth IRA conversion is. The other thing to consider too is that our current tax rates are based on a tax act, Tax Cuts and Jobs Act, I believe is the name, that was passed in 2017. That is set to expire at the end of 2025. So we only have 2 more years at the current tax rates, unless Congress passes a new tax bill that goes into effect for 2025. And once that happens, tax rates will go up a little bit for everyone. It's not a massive increase, but it's definitely an increase. So you might want to take advantage of a Roth conversion this year and next year, knowing that what our current tax rates are. We don't know what the future rates may be. They might be higher because they revert back to what the previous rates were, or they might be higher because Congress passes tax rates. One candidate that's running for president is talking about much higher taxes for many people. Another candidate is talking about keeping taxes the same or maybe lowering them. So a Roth conversion can make sense. And we still have time in 2024 to do this. This has to be done in the 2024 tax year. So as a retiree, looking at what you have in your pre-tax retirement accounts, looking at what your projected retirement income is for this year, and making a decision about how much to convert. I've talked about this before, but if you could convert taxes at a 12% rate, that would be phenomenal. If you still have the ability to convert up to the 12% tax bracket, I'm not going to talk about what those numbers are, but that would be good for you to reach out to your CPA or your advisor. And that could make sense because chances are, I believe tax rates will be higher than 12% in the future. The next bracket up from 12% is 22. That actually might not be that bad either, because it's possible that tax rates could be higher than 22% for you or your beneficiaries in the future. So definitely looking at that is an important thing to do, and it's not for everyone. It's possible that maybe you won't get tax savings by doing this conversion because your taxes will be about the same in the future. Or maybe your beneficiaries have lower tax rates than you, so they actually would be better converting at their tax rates. But the hard thing about any of that is we don't know the future. We don't know what tax rates will be in the future. We're making an educated guess, but we do know what they are now. So that's why a lot of people are considering Roth conversions that have been fortunate to have significant pre-tax retirement accounts, especially if you have a pension and you're getting Social Security as a retiree. You might not actually be spending all that money, and you're now thinking about, all right, what can I do as far as a legacy, and how could I set that up for my children or grandchildren? A Roth conversion can be great because not only will they inherit the money tax-free, but the money will grow tax-free. So if you convert $100,000 this year, let's say, into a Roth account, you'd pay the tax on the $100,000 in 2024, and now you've got $100,000 over in a Roth IRA. That money will grow, and then they'll get even more money tax-free. Let's say that $100,000 doubled to $200,000. Now your beneficiaries have $200,000 tax-free. What if it tripled to $300,000? Then they have $300,000 tax-free. So that's the power of the Roth account. Not only will it be tax-free, but also any growth after you convert it will be tax-free. The fourth thing to think about is required minimum distributions. So these start for anyone that's turning 73 this year. So if you're turning 73 this year, you're supposed to take out a required minimum distribution by the end of the year. For the first year, however, you have a special exception that you can wait until April 1st of the following year to take out the required minimum distribution. The only problem with doing that is that if you wait till next year, let's say, to take out that distribution, you'd also have to satisfy the 2025 distribution by the end of the same year. So that's something to consider. Number one, do you have to take a required minimum distribution this year because you're turning 73 or you've already turned 73 this year? Is it better for you to take it this year or next year? That's where some tax planning can come into play. Again, looking at your current income, how would that required minimum distribution change your income? Is it better to do it this year or next year? So that's definitely something to consider if you're taking your first distribution. If you've been taking distributions for a while and you have to take one this year, a big thing is to make sure you take it, right? You can't avoid taking that, because if you do, you'll pay a tax penalty, and the tax penalty can be kind of steep. So definitely make sure that you do that, but also for anyone who's inherited an IRA. I talked about this a few episodes ago, but again, as a recap, if you've inherited an IRA from a spouse or from a non-spouse, you potentially have to take a required minimum distribution from that account. So you want to understand what those rules are. I'll put a link to that episode. Go back and check that out. But even if, as I mentioned in that episode, if you don't have to take one this year, you still might want to take one because of the fact that maybe you're going to pay a lower tax rate this year than you would based on future years. So that's something to think about. Tip number 5 is thinking about capital gains and capital losses. So it could make sense for you to realize a capital gain this year. Maybe you're in a lower tax bracket than you'll be next year, so it might make sense to pay the tax, or it might make sense to wait until a following year to take it. That's where some tax planning, thinking about that can be helpful. But also if you have any losses on your investments, if you bought investments in the past or even this year that are worth less than what you paid for them, it can be a good idea to capitalize on that loss. And what do I mean by that? you can write up to $3,000 of a loss on your tax return for this year. So that's a deduction that you could create if you have a mutual fund or a stock that you bought and it's currently worth less than what you paid for it. The other thing is that if it's an even greater loss than that, you can use that to offset any gains this year or in future years. So keeping an eye, if you have taxable retirement accounts, on what those investments are doing. Are they worth more or less? And then strategizing about when it might make sense to either realize the losses or realize the gains. Tip number 6 is making sure that you're paying the correct taxes every year and have the correct withholding. You don't want to end up paying the IRS a lot of money and then getting a big refund. It's not a great idea because you've given a tax-free loan or an interest-free loan to the IRS, so you want to make sure that you're doing the correct withholding. The second thing is that you don't want to owe a lot of money because you'll have to pay potential penalties. If you owe more than $1,000 to the IRS, usually you'll have to pay a tax penalty. So that's where it's a good idea to make sure you're doing the proper withholding, especially as a retiree. It can be a little different because you've got income coming from different places. So you want to make sure you're doing the correct withholding and then make sure you're adjusting it for next year for any changes that might be going on with your income. And you always want to make sure that if you have to pay estimated taxes because you owed more than $1,000, then you make sure that you pay those payments because they're due 4 times a year. The most recent one was just due, I think, September 15th or 16th. So you want to make sure that you do that as well. And then the last thing is that there could be, tip number 7, there could be income tax breaks depending on the state where you live. There are a number of states that are regarded as the most tax-friendly states. I looked up a report from U.S. News, and I'll put a link in that in the show notes. The most tax-friendly states are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. However, I live in the most tax-unfriendly state, which is one of them, Connecticut. We have some of the highest taxes in the country, but Connecticut realized, like many other high-tax states, that a lot of retirees were moving because of the high taxes. So they've tried to incentivize retirees by offering them tax breaks if their income is under a certain level. So I believe as a married couple filing jointly, if your income in Connecticut is under $100,000, you can potentially pay very little state income tax if your income is coming from Social Security and retirement account distributions. I believe the number is $75,000 as a single individual. So again, this is something to look at with your CPA, with your financial advisor. Are there any tax breaks in the state where I live in, if that state has income tax, where I can keep my income under a certain level, possibly for a certain year or maybe multiple years to have some tax savings? So again, that's something that you need to be thinking about. And then, as always, you could also consider moving to a more tax-friendly state, a state that doesn't have state income tax or maybe doesn't tax retirees, because that can be really helpful. There can be some tax savings. So again, these are the 7 tips I would suggest you think about, talk about with your financial advisor, with your CPA before the tax year is over, as we still have some time in 2024 to do this planning. And if you're interested in checking out my either in-person or on-demand retirement course, consider going to retirewithryan.com and clicking on courses. And as always, if you have a question you'd like to have considered for a future episode, you can go to retirewithryan.com and ask a question. Have a great week, and I look forward to talking with you next Wednesday. Take care.